So essentially your concern is around validator concentrations. As you put out this research, what assumptions were you making about just how big these products could become? How big would they need to be to create this kind of concentration risk?
Well, Kailey, Sonali, thank you for having me on the show. Absolutely. I guess picking up on where Emily left off, there are 8 applications in there currently under review by the SEC, and 2 of those contemplate the staking of the underlying Ether, so that they would be not only holding the asset, but they would be participating in the Ethereum network as a validator through certain intermediaries or protocols, and how they might choose to do that could have significant impact for concentration risk. So if you just look at the total volume of staked Ether today, it's about $90 billion equivalent. If you look at the current concentration through the Lido protocol is just under a third of that, and the concentration staked through Coinbase is about 15% of that. If you then look at the inflows into Bitcoin ETFs, take that as a comparable. We're not projecting what the actual number might be over a short matter of months, but it's easy to see that the number could be big enough to move the dial.
Well, what are you most concerned about here? The fact that the concentration risk creates security risks, or just is this an economic concern that too many players, or too few players rather, will have too much of the pie?
So concentration risk matters when it comes to Ethereum because it affects the consensus mechanism. So in order to have financial settlement guarantees when using the Ethereum blockchain, you need to have finalized blocks. So the new block that has your transaction, you need that to be finalized. That is what makes it immutable. How does that block get finalized? It gets finalized when you have the consensus of 2/3 of the validators participating in the network. So if you have concentrations within that validator set, you start having risks that perhaps you don't have 2/3 of validators available. Perhaps they're offline. Perhaps they're acting in a way that's maybe censoring transactions or otherwise not beneficial to the broader network. So if you look at this happened last year, for example, in May, there was a delayed finality event on the Ethereum blockchain that lasted a few hours. That at the time happened due to a bug in the software that some of the validators were running. But if you consider that some of the stake may be concentrated in specific places, be that an entity or a protocol, you could have a concentration of operational risk that could lead to validators being offline. And that introduces risk dependencies and trust assumptions in a network that is trying to be decentralized. And so that's just a very important development to monitor from a risk analysis perspective.
Just from a price perspective, quickly, Andrew, we only have about a minute left. All of these concentration concerns on the network itself are one thing, but what do you think actually could happen in terms of prices, considering what we're seeing with Bitcoin north of $57,000 after the introduction of spot Bitcoin products?
So I think long-term, what drives demand for Ether is the use of the network. And the use of, therefore, Ether for covering transaction costs on the network. So to the extent that there are concerns around concentration in the network, that could be an inhibitor to growth in its use. Conversely, to the extent that these risks are kind of managed in a robust way, that we see diversification of stake, then that may be less of a risk factor. Clearly, there's a strong interest in the ETF development. That will be one factor driving prices. We don't have a price projection out there on any of these assets, but those are the dynamics.